Alright you guys, so haven't done a video in like probably a month and a half, so it's gonna be a little bit longer, and I think I lost half the audience, so maybe now I got like 2 listeners. But anyway, for the 2 people out there that listen, I'm gonna go through these charts and show you more of a macro scale, and talk a little bit about earnings and some things to look at. And so with Bitcoin, obviously we saw this breakout to this 2400. I went short on just a small amount with APE and GMT. With GMT, it got caught off size on that, and so I'm down on that play. But on APE, I'm pretty much even at this point, even though we had this big rip up, because I think I might be up a little bit on that actually. But I'm not going to get into those like smaller plays. I'm going to talk about the larger stuff here. So we go to the SPX S, which means short on the SPY. And so if you don't know, there is SPX, okay? And so this is what futures traders used, and the reason you have this other decimal, right? Because the SPY is like, it'll be at like 400, but you have this other decimal because futures are on leverage. So when we trade with when I trade with SPXS or anything that's at leverage, because SPXS is 3 times leverage short on the SPY, I use these levels. So that's something you can do to get really to fine-tune your entries. And so what I've been talking about is shorting the short squeeze. So every time, if we put on, I'm not going to rush through this. I'm just going to kind of take my time with this. So if we go to the daily and we look at let's put this one on, okay? And so when I say short the short squeeze, this is what I mean. So you have the 200 moving average. And so everybody talks about this. This acts as a big resistance, okay? And so what happens is a lot of people will just short this line, and that's fine to do. But what I try to do, because I'm using leverage, is I short. I know it's going to squeeze above this line. Look, every time it squeezes above that line, meaning that buyers come in also at this level, and it can pop above it. You can see this got real squeezy here. This is a pretty big squeeze, right? And so bull market, you're trading above it. You see how this line is always above it, moving to the upside, and then it crossed over, and you can see what happened when it crossed over this big move here. So that's what I mean by the short squeeze. So that's a safe way to play on like a macro scale, even if you're to do that once a quarter, or once you could just make, you don't have to pay a lot of attention. You could just play this one line, and anytime we come into this 200 day, if we're in a bear market, you can short at that line. That's fine if you want to, you're not going to get the best entry. But if you short the short squeeze, you find this level here or here, and you start to make your entries accordingly, right? And so with the SPX on Friday, we had this big move up. So what I had done was, because I believe that we're heading for more downside. I think that these earnings and with Powell and all this, that we're going to possibly see a lower low. And so because you don't always know, what you can do, and what I did is I added some short here, okay? Because it could have just hit this and come down. The 200 day could hit this and come down. That could act as resistance. So I did half my position here, and then on Friday I did the other half of the position here, because I was pretty sure that we were going to make it above, but then we will come back down. Okay, hopefully that makes sense. So if we go to, with the NASDAQ short, I didn't do the average down. What I did was I waited on that one because it's a lot more volatile, and I was able to tag this line right here. So I got in to that 30.78, so right around, or what, 30.72 was my first order, and then in the same day I had one for 30.12. So I tagged that line, right? So all of my orders, so I'm actually in probably around 30.38 on the NASDAQ, which is still for the short. So Tech S, if you don't know, is how you short the NASDAQ without having to sell short with shares. You can just use these ETFs at leverage, and it's a safer way because you don't need the margin and stuff. So hopefully that makes sense, because if you don't know what margin is, you can get wrecked if you're out there trying to short. So I entered, and I did it early on Friday. I had things to do and I didn't want to wait, but if I kind of intuitively knew, wait till the afternoon. Anyway, so the idea being that I'm in both these plays now. I'm short on the NASDAQ and I'm short on the SPY. So the reason for that is we have the earnings coming in, and we put in this pretty decent rally. So I'm going to flip over to the SPY to kind of give you an idea of where we're at today. And you see this 400 level is a key level. And so on the macro, when you look at this, we have this trend line from the top of the highs last year in December, and we found in this downtrend. And so every time we hit this trend line, we have confirmation, confirmation, confirmation. See how each time we come up and that price hits that trend line, it comes down, hit the trend line, come down, hit the trend line, and look how we squeezed above it. That's what I anticipated. And that's because following news catalyst, knowing what's going on with earnings. Earnings did not come in. They've been basically dependent on future guidance. The earnings right now, no company is in deep shit. They're all just pretty much reporting, moderate earnings, nothing great, but companies are moving off of guidance for next quarter. And so this is Friday. So seeing as we had broken this trend line, seeing as we were above the 200-day, we had broken the trend line, we're above the 200-day. I knew Friday, because we had done that and things get squeezy on Fridays, to put in the rest of my short there. So as you can see, I probably tagged it right around here. I think I had like 404 was a place where I was paying attention. And then you can see it sold off today, and now we're right back at this level. Okay, so on the SPY and on the macro, what that means is that we have a lot of support right here. Okay, so this could play out slower than people might think. A lot of people think the market and that the shit is just going to hit the fan overnight, but it really could look where the market consolidates here for a little while, meaning a month and a half, 2 months. You could see this weird level. That's a possibility. So I wouldn't be surprised to see that happen, that you get some sideways movement. But we also have a lot of news catalysts that are possible. Ukraine, supply chain issues, all the regular stuff, right? And so if there's a news catalyst or some data that comes out, then this is what I've been talking about for probably 6 months now, is finally hitting these lower lows. And so that's why I went short here. And probably what I'll try to do, unless the market's just going to move sideways, I'll pay attention to the news and see, hey, the market's starting to trend back up. I want to take profit, but if I think things are just going to continue down, then I'll just hold that position and wait for these lows, but not be too greedy with it. At that point, on a 3x, if we come down to this target range, 14, you'd be about 45% of whatever you put in, that would be your profit. You could say like 40 to 45% gains on that play. But I would expect this to take, 6 weeks, 8 weeks, even 3 months to get down to this target. That's, so this is macro. This isn't going to happen overnight, but that I'm going to sit in these plays and see what happens with that. So the one thing about Powell is that the idea is the market keeps looking for a pivot, and they're kind of at odds where the market is trying to force Powell into something, and I don't think he's going to go for it. I think that he's made abundantly clear they're going to stick with this plan, but the market always wants to believe something different, and that's kind of what we're seeing. It's almost like it's kind of adolescent, it's very emotional right now. So Powell with one or two phrases could come out and send this thing down and send the whole market down back. This would not be hard. We were just here in beginning of January. This is where we were at. So for us to get back to this 380 level, 378 would not be impossible. 383, that seems more probable than not at this point, even if you are going to see a bounce, because I don't think it's going to be all bullish with earnings. These earnings reports aren't going to just suddenly cause the market to rip. Powell's not going to come out and say something that's going to cause the market to just rip. I don't think, but it always could happen. I mean, it really could, but the odds of that, it's all just, like they say, it's speculation. It's just your best guess, and my best guess is that that doesn't happen. And so, my money's on at least coming back down to this 374, 384 range on the SPY, and that's how I feel about it. And then ideally, if it plays out how I think it really could, you should see this 340 range. So, but that could take a while. So that's what's going on with the SPX and the SPY. And then, so for the macro, I was in the UNG play. I made some money off of it. I did pretty well, and then I got totally destroyed. And this is interesting to me because I was playing around with it up here. This is October and stuff. But what happened was I bought back in here, which in the pattern, we had a lot of support in this pattern. And I remember saying, like, this shows us something big about the economy, because this is natural gas, right? And so we have natural gas going back to 2020 levels. So let's go to, let me see, because I haven't done this. Let's see real quick. What is this? So that's December of 2020. So this is pre-COVID. Right. So then let's see what this is. What is this? October 21. So you probably have some return to work because they're lifting the, people are going back to work here. So energy, basically, the demand for natural gas went up. But even during the COVID, so this is what I'm trying to show you guys with this. This is natural gas. Why is this important? Because if we look back here, you go to this COVID area, right? And you go back to, you see this 2019 range, but then COVID, it was selling off. This is just, who knows what's happening with the price action there. But basically what I'm pointing out is you're at these ranges here. This is your COVID era. This is where people were locked down. So what happened to demand? It went down. Interesting. Okay. So what this shows me, and it sucks to be down, but it also, that's why it's good to put money into something, because it causes you to come back. Even if you put in $100 into UNG, and all these plays are small for me, but it causes me to think about this differently. That's why you want to invest in these things. So it forces you to come back and to know what's going on in your world. And so what we see here is that in December, when everybody was talking about the crisis and the weather, the crisis with the natural gas in Europe, that was this play. And what happened was we had a more mild winter, but also something that the charts show you that the news won't show you is that there's something that's happened to demand. To me, this is an indicator of a slowing economy because the demand should be at least keeping up with these levels here, right? Why aren't we keeping up? Well, something has happened to natural gas where the demand isn't as high. Some of that's going to have to do with regulations because the reptilians are trying to take over the world with a climate change narrative and ban stoves and stuff, but that doesn't account for this. This is showing us demand destruction in a commodity. So I want to show you something else that goes with this. So if we go over here to the oil fund, okay, and remember let's go to, let's see if this one will do it. Yeah, okay. This is my better chart for this. So everybody was familiar with, gas prices up, right? We had hit this 123, we had hit 130. So this is when there was demand. This is demand, but there was not supply, right? And what's interesting is a lot of people were freaking out here, and I said it's very possible at that time to see 148 on gas. But what has happened is that we hit this downtrend. You see this wedge comes down, it broke, and we can't get back above this level. So this is where gas prices, and I had said this back then, gas is never going to come back down to where we were, look, December of 21, and then certainly not down to where you were in 2020. You're still way above that. So two things, actually I shouldn't say never, because two things can happen here. And so you're looking at commodities, and so like now China just reopened today officially, even though they've been talking about it. And so that's going to take time for China to start ramping up manufacturing again, and that can send gas prices higher. So you could play it like that and say, well, with China reopening, gas prices could and should move higher. That's one way to look at it. I'm not playing this, I'm just showing you an idea. But looking at natural gas, we're seeing demand destruction. So even with China reopening, but we're seeing a slowing of the economy, right? Because UNG, as I pointed out, this indicates to me that there's not a demand, right? So the same thing here. And it's just not as drastic because, this is a lot more stable. UNG is volatile by nature. It's a smaller market cap. So then the thought here is to pay attention to these levels. If you want to know what's going on in your world, what to expect is if you see gas start to slip below the 75-30 range, that's an indicator of a more macro problem as far as like the manufacturing has not been able to create enough demand to outweigh the fact that people are not traveling as much. They've all kind of pulled back at this point on spending, and so that's demand destruction. So with crude oil, that's what to look for is like if you see this start to break here, then that's showing you the signs. Like I was telling you guys back here, and I was talking about this a lot. There's one of these calls that I made in June right here where I said this is where people are going to worry about the recession, and the recession is going to start to be a part of the conversation. And look at what happened. So this will tell you that if you see this move up, then that would be more in a way more bullish for the market, but not enough to really move it, but it gives you a macro indicator of what's happening in the world, right? This will kind of show you if gas prices kind of start to tick back up here, then that means people have a little bit more money to spend, and things in China are starting to ramp up, but that could take a couple months, right? So just keep an eye on that. The idea here is commodities to pay attention over the next quarter or two, what's happening with that. And so if we get the one play, so on this macro scale, the one play to look at is right here. And so this is the yen versus dollar. And so on the macro, what's happening, a whole nother category, is the Bank of Japan emergency meetings, and what they basically did is they said that they were going to cut rates, or not cut rates, they said they were going to increase rates, but at the same time, 2 months later, they came back and said, we're not going to do anything. And so you see this is from December. So in December, they said this news right around here on this day. You see this big move up. It's because they said, okay, we're going to increase rates, and the yen shot up and created this move here. And so on the macro, what you want to look at is that you're looking for a pullback. You're looking for the dollar to strengthen. So to put this all together for you, the dollar's at this low. Let's say that the stock market starts to sell off, as I'm talking about. So this is macro play. Think about what I'm saying. So the market starts to sell off. What happens when the market sells off? The dollar goes up. When the dollar goes, so the market sells off, the dollar's going to go up. Okay? So what would that do to the yen? That would bring the yen down, right? Because it's against the dollar, so that it brings the yen down. On the macro, these are big plays. These are macro plays. They're not like in and out. So let's say that the dollar surges, it brings the yen down. This is a probability at this point, because they're not doing anything in Japan right now, but when they do, it's going to surprise the shit out of everybody, and that's what I'm talking about. And they are going to do something between now and September. So what you do is, because you don't want to trade Forex, because that's really complex and a whole nother world, is you can go to something called YCL. Okay, and YCL, this is the yen. Okay, and so what you can do is go long the yen. Now, the reason I'm showing you this is, look at the upside on this. So the yen has gotten completely destroyed. Look at this range, destroyed. Let's put this on for a second so we can see. Destroyed. Right? You see this? I mean, this is how long this has been around, but it goes back even further. This ETF has only been around since 2009. That's why it stops here. But so this is reflecting the price action of the yen versus the dollar. Now, the yen's a reserve currency, okay? And so what you're seeing, and you can see this isn't, you see how the bars are not complete, because nobody knows about this one. So it's not something that normal people are trading. It's something that, if you're one of the 2 people that are listening to me, it's the most savage information that you're going to get. You know, it's real shit. So you see all these little ticks, it's because there's not a lot of volume on this here, right? It's very specialized kind of shit I'm talking about. So anyhow, what you're looking for is the market starts to sell off, right? In this play that I'm showing you, the market sells off, which brings the dollar up and the yen down on the macro scale. And so what you're looking for on this is a longer term play, and not worrying. You don't want to micromanage it. Just think about it as a 6 to 9 month period, or even a year. But if this happens over the next couple of weeks, if we see, or the next time the market hits a bottom and the dollars, or if the dollar surges for some reason and this drops, and if you can tag it at this 31.43, I mean, 34 is not a bad range, but you're at a top, and it's very possible if we get a big pullback, this would be a good play. This would be solid. I'd feel very good about, and very safe, getting in here the reason is if Japan decides to increase rates and you can time it correctly and that scenario plays out, we never know what's going to happen, but say the dollar surges and you get an opportunity to hit this at 31.43, you're very much at a low. Okay, this thing's never gone below 26, so your risk there for an all-time low is 15%. And then if you look at the upside on this play, even from the levels you're at right now, you're at 34, and you can see this is a rounding bottom that is forming. But let's say that later in the year they come out and they really cut rates. This is going to surge, or I keep saying cut. They increase rates. This could easily surge, and it could break out. You could have a huge move on this, and I just like the idea of there's not a lot of volatility in this right now because it's a world currency compared to what I'm used to trading. A lot of people might say, "What are you talking about?" But because when you're on Forex, there's a lot of volatility, but with this, there's not a lot of volatility, and you might be able to hit something that pays out pretty good if you leave it in there and time it correctly. You could make 40%, something like that, which would be, that would outpace the bull market. That would be, half of what Bitcoin made in its bull market, or from 2019 to 2020. So anyway, something to pay attention to is the yen. As far as other indicators and things that I'm looking at, so when the market comes down, the one thing I'm looking at is to start to position for some long, and I want long with dividends, right? And so I'm looking for stability, long with dividends. And so one of those that I'm already in, and they have earnings tomorrow, is Mo. And so Mo is basically Marlboro cigarettes. This is a funny story here. This happened. This is not real. They had 80 some stocks had a glitch in the matrix last Tuesday. This is a whole nother topic. But anyway, so discount this bar because that's not real. But what I want to show you is I entered into Mo somewhere around here. Here you go. 43, right? So on the long term, why I like this is because you think Marlboro cigarettes, and why would anybody invest in that? Because their business isn't going to be cigarettes in their future. Their business is going to be with weed. And so as that becomes less and less regulated, I'm positioning myself now. If you look up their exposure to that industry, it's huge. So this could be one of those stocks that has always traded very, it stays in a range. It's not very attractive to a lot of people, but if you catch it at a bottom at this 40.98, like I put in another order today for it, and I'm going to start to accumulate some of it because it pays a dividend. And then let's say a year, the market, let's say what plays out is we have this recession. You're still getting a dividend, even if you're under on it. You're still getting a payout because of the dividend. But during that recession, what could happen is states and economies have problems. And so if states and economies have problems, one way to solve that, like they did in Washington, is to lift the regulation. And so that creates tax dollars. And so in a recession, they're going to need tax dollars. And one of the ways to do that would be to deregulate weed. And if weed gets deregulated at any time over the next 3 years, this is going to explode. This will be the #1 weed stock. Everybody's like talking about weed, or not everybody, but there's people that are into that, buy weed stocks, which is a total gamble. But this is a company that pays a dividend. It's been around forever. That's going to dominate that industry. It's going to all be run by Altria Group. And so That's why I like that. I'm gonna stick to that. The other ones are the defensive names, and I wish I had an order in for Raytheon. I did not get filled. I had my order in just a little too low, and I ended up not getting filled. But any of these defensive names on the pullback, Lockheed Martin, General Dynamics, these are all like these are wartime trades, right? You're in wartime. So even if there's a big pullback in the market, these are all going to come down. And so if the SPY comes all the way down to a bottom, I'm showing you what I'm looking at when the SPY bottoms. So these are basically your wartime plays, right? And you're in this, depending on your viewpoints, it's at least going to be another year. But my guess is this goes on for decades. Look how long you were in Iraq and Iran. So the idea that this is going to conclude quickly is, not realistic. Anything could happen, or shit really escalates, and which is more likely is that things escalate over this year. The Ukraine thing's been on the back burner. People aren't responding to it or thinking about it. You had winter time, so strategy with if you're in a war, what you're going to do is have seasonal moves. And so what they were planning in the summer, what they were going to do in the winter. So Russia has taken over. Kiev essentially is destroyed. They have one whole part of the Ukraine that is carved out, which is now Russian. And then they came around up into a bay, more or less, a big port, and they took that port. So Russia, as a different than what we hear here, Russia is definitely winning. It's a mess, but it's going to go on for a long time because now Russia is fortified in Ukraine. They have no thoughts of stepping down, and in the springtime, it's likely that war will escalate because in the spring it allows you to move troops, it allows you things you couldn't do in the winter because of the cold and things like that. So this could really escalate, and if you see a pullback in the market over the next month or two, these hit a bottom, and then you have an escalation where there's more demand for the products that these people make, then this is gonna shoot up. So that's something to pay attention to. Then what else is on here? Hey, sweet. I'm doing a video, so give me a minute. And so what else, man? That might be it. The VIX, that's the last thing I want to show you. So the VIX, each time you have these, okay, so the VIX being at a low shows us that the market probably has a big move incoming. You can see how when it hits these ranges, look at what happens next. Boom, range, boom, little pop. That's a ghetto pop. But we're at this low. We just look at this little weird pattern. You have this big wedge pop and a wedge lower, and look at what happens with this. So if we see the VIX start to move up, that's what we're coming into one of these moves over the next couple weeks to a month, where this is going to start to move upwards, which would be bearish for the market. So this is a way of seeing, are we at a top in the market? Yes. By looking at the VIX, you could say, and it can go lower, which means the market could go a little higher. But these basically, this is like an inverse way to look at it. So VIX low, market high. So that's what to look for. But we're already there, so you don't really have to pay much attention to it. And so look, you have a gap up right here on the VIX. which isn't that significant because it can come right back down. But this is showing us that on the macro, we probably should see over the next couple weeks some volatility come in, and that volatility should be to the downside because we're at a top. So that's what I would look at there. I was able to get out of my Tesla play. I was amazing. That's why, you know, holding shares is better at this point, because even when we were down here, I wasn't that worried. I was like, well, I might own Tesla up here. I was able to get out of it. I just sold out of it. So, all right, TLT. So this is also another thing to watch for, and something I'm interested in is in bonds, and you know, and actually putting some of my money into bonds. 1-year T-bills, because they're paying about 4.75, and it's guaranteed. It's not. It's like a loan. You're basically loaning the government money, so hopefully they pay you back. It's more likely they pay you back than anybody else at this point. So anyway, if we see a pullback here, which is possible, the bonds are looking kind of shady. Everything's looking shady moving into Powell. But you can play bonds by buying bonds, and that's a guaranteed return. But the other thing is you can play the paper, which is the ETF. And so essentially, if you see a pullback here, you could move into this. That'd be safe on the macro. So when I'm saying that, I'm saying you hold this, you start to average into this. We're talking about like longer term. So if we see a pullback here at 99.47, you put $1,000 or $200 or whatever, $10,000 into this play, depending on the size of your account, and then you let it ride, right? Because when this recession hits, which it's going to, all of the equities are going to get totally destroyed, and what happens is people rotate into safety. And so that's what's going to happen is as people become more afraid, and we haven't really seen that yet. We saw a little bit of it here a couple weeks ago, but the fact that this is selling off, if this sells off while the market's selling off, that's kind of what I'm looking for. I want to see this sell off with the market selling off, see if we can come down into the bottom. And then when the recession hits in October, November next year, I'll have already started this play, so I'm way ahead of the game. That's what you need to be aware of. That's what I'm trying to help you with, is that you put a little bit of money in here, and then when the recession hits, what happens? People rotate into safety, and the bonds shoot up. So when the Fed pivots, the first thing that's going to happen is, so they're going to pause and then pivot. On the pivot, the market's going to shoot up, and bonds are going to shoot up. So I want to hit it while it's at a low, because we know the pivot's coming, right? Now, the other interesting thing and why bonds are, this TLT is going to be a good play is because you're doubling down on it. You're going to be able to hit the pivot, right? Because they're going to say, okay, we're going to start cutting rates. The market's going to pop off of that. But what that is an indicator of, pay attention to this idea. What that tells you is that the damage is sufficient to cause a macro problem in the U.S. economy, which means, in short, that the equities, the stock market, the next quarter, October, or even next winter, is going to really start to show the effects of these rates. The market hasn't had the effects of these rates yet. That's what this is all about. So the Fed pivot, the market will explode. So the Fed pivot, what's going to happen is the market's going to pop. It may make a new high. So this is you want to be long, but you don't want to hold all these equities through that. This is long term. So it's like the market pops off of October, November, or it could be September, that quarter. You could get a pivot. or October, November, you get a pivot, the market pops, but that's a showing of contraction, which means that thereafter, that's where we enter into the recession, where the earnings reports and the profitability of these companies starts to come down. And when they come down, everybody knows this who trades, when the equities come down, that money's got to go somewhere. So people start coming out of equities and they go into bonds, which is going to send TLT up. You see me? No one sees me. Two people. So the two people that see it follow what I'm saying, man. Because this is very likely going to play out. And so when this is in 2020, look at what happened. I was in this play. Look at what happened. This is the COVID shit. So people freaked out. Look at what happens when the world was falling apart and everybody was going to die from COVID. Bonds shot. Look at that. Tuesday in March. So think of what was happening in March. This is your COVID crisis. The market's crashing. Look at what happened to bonds. Look at what happened to TLT. Everybody flooded into bonds for safety. You see what I'm saying? Now later, this is the quantitative easing and then easing hadn't started yet. This is the actual crisis, and it came back down because the entire market, the entire world had crashed right here, right? So everything came down. So that's what I'm showing you with bonds. When people panic, and we're not going to have another one of these COVIDs likely. So we'll have other stuff, which is a slow die-off of humanity because they were all injected with a bioweapon that distorts DNA and basically is a Luciferian agenda. But during that time, bonds are going to shoot up because anyone who has any money in the market is not going to want to sit on it through a recession. Part of that money is going to go into bonds. All right, my friends. I hope you're tracking and keep on keeping on.